Well, hello, everybody. Welcome to Wall Street Hackers, one of the most popular programs on the IBM TV, Pod TV network, broadcasting in the United States and around the world. And we're going to be discussing, of course, things we usually discuss, from the quotes of the week to the stories of the week till Peter's pick of the week. And, of course, the general market conditions that exist today here in the United States and around the world. So with that, we're going to bring in the hacker himself, the graduate from UCLA, where he received his degree in economics, also a law degree from the University of Miami, and master's in business administration from NYU. Spending 17 years on Wall Street, the hacker himself will bring in, he'll give us our tips of what we should be looking at in the market going forward, Peter Bennett. Peter, as they say, welcome to your show.
Oh, thanks. They always say that, right? Hey, Nick. Hi, audience. So it's another exciting week on Wall Street, a lot going on. You can catch a new edition of Wall Street Hackers most Thursdays or Saturdays, depending on your distribution network. So before I begin on the general markets, I want to mention one thing in the specific markets, which is very good news. Our number one allocation, I have over 20% in there, and it's MPLX. I love pipelines. I think they have utility-like safety with high-end growing dividends. I can't find another sector, and I love energy anyway. Announced a 9.7% dividend increase this year and bringing the dividend somewhere around 9.5% again. So I'll take that any day of the week. In terms of the general markets, I have a new expression, I guess, for this week. I would say the markets have moved from delusion to confusion. So the markets are starting to wake up to the fact, because the news keeps coming in, and to what we've been saying for a year and a half, that there's a lot of issues in the markets, and the economic news keeps coming in that says inflation is not under control, and that means we're probably not having a soft landing. Also, tech has no longer been driving the market for the last month and a half, whatever. As a matter of fact, tech, the NASDAQ is down 10% since the high in July. The market, the S&P 500 was at 455 in July. Now it's at 414 as of this morning. So it's not only a downtrend, and I'm not a technical analysis person. I like fundamentals, basically. I'm buying businesses with high dividends and high streams of income that I think will be a lifetime of income. But if you look at the technical side, that is a downtrend. I mean, it is, one of those loop down, loop down, loop down. And it's a scary time because, as we've been saying forever, inflation is not under control. And the reasons we always say it, and we keep getting news every single week just about it, is unemployment is near historic lows. It still is. Energy prices are likely to rise from here, even though they're high or pretty high comparatively. And government keeps spending and spending. And then what do? They do more spending. The deficit on the books is $33 trillion. We'll discuss the deficit more in this week's Investments of the Week section. We're going to be discussing whether to go short-term cash or long-term on bonds. But it's unbelievable how they basically are going to have to, the government will have to deal with this, and the world governments too, because everybody's basically putting themselves in this huge deficit. So I'm sort of changing my position in a sense, because I think that rates won't go up a lot more. And maybe a quarter point more. If I was the Fed, I would do a quarter point more, but I'm not the Fed. Maybe even a half point more, but I don't think they need to get rates much higher on one side to get inflation under control. But that's because what Fed Chairman Powell has said, and I've said, is higher for longer. That's a quote. He's been saying it for over a year. And that's the problem. The market does not count in the fact that we're going to have higher for longer, and longer can be a really long time. And eventually, high rates are going to affect corporate earnings. Corporations are eventually going to have to refinance at higher rates. It will slow the economy, and inflation itself will slow the economy because people just won't be able to afford things quite as much, unfortunately. It is a tax, essentially. So the market will eventually realize it. But what we saw this week in the news, and this was a big thing in the last week or two, the bond market has finally woken up to higher for longer. So all of a sudden, not only can you get around a 5% rate on a 2-year or a cash, but now the 5-year, the 10-year, and the 30-year are around maybe a little under 5% too. That's a big change, and Chairman Powell will notice that, because when rates in the short run were high, that was one thing for companies. But now, when they need to refinance, if a company has things due, basically refinance, basically they're going to be at 5%. But also the other thing is now there's a real substitute for stocks. It was one thing when you said, okay, I can get 5% in cash or for 2 years, because you might say, well, I'm a long-term investor, a medium-term investor. I want to buy stocks and I want to return higher than 5% going forward beyond 2 years. But now there's a real substitute. 5% or close, especially in an IRA or a 401k, is a substitute. So people have to say, well, do I want 5% with no risk, essentially, except for inflation risk, or maybe a high return in stocks, maybe not. One analyst this week said he expected 8% return on the market over the long term, but that's 8% with risk. So who knows? As Nick mentioned in one of the other shows, there was a period of 9 years when the market didn't go up at all. And I think it was Cooperman is saying he expects 7 years now of no progress in the market. I don't know if I agree with that, but I think it'll eventually go up, but I'm not sure that you want the risk, especially now. Maybe it'll go up from a lower point. The second story of the week that really, again, confirms what we always say is Chevron bought Hess. A week or two ago, we were talking about Exxon buying Pioneer. These are huge acquisitions. So the point is, Chevron bought Hess. Instead of spending their money or instead of focusing on new development of energy, they instead decided, you know what, let's just merge. And they did pay a bit of a premium price. Last I looked, it was $162. They were paying $171 a share. So basically saying, well, we'd rather just acquire somebody who has the oil instead of spending the effort and the risk and the capital on new oil exploration. But this has been going on since 2015, when oil companies started spending less than half of what they used to spend on oil. And where is the extra energy coming? The world still needs more oil. The world population keeps growing. Solar is not replacing wind in terms of getting rid of the demand for oil and gas, because the thing is, it will substitute for some oil and gas demand, but energy use in the world is very likely going to keep on growing as developed countries need more. So oil and gas will at least stay neutral. Gas will probably go up for the next 10, 20, 30 years. Oil maybe stay flat, and solar will grow, but it's not going to substitute for it. So the oil and gas companies are being very reluctant to use their capital, but they're spending 10% of it, by the way, on ESG projects, environmental projects. So the money's not going into the oil fields. Since they're 5 to 7 year projects, sooner or later, this could be a real issue or even a black swan event where it's like, we're way behind on oil investment. And then the third thing is, you look at everything going on in travel, in different sectors of spending, retail spending. A perfect example is family housing starts increased seasonally 3.2%. So you say, wait a minute, where is the economy slowing down? Well, it's not slowing down a whole lot yet, which means inflation's not slowing down, which means it's higher for longer. And that is very likely. So again, my investment sort of forecast or focus is now that rates will go maybe a tiny bit higher, and that'll be the discussion of the week again. But I don't think they're going tremendously higher, and I could be wrong. They could go anywhere. They could go low, they can go high. There's never a guarantee. But the point is, now we have to kind of dig in and get our returns in an environment where things are going to be pretty flat and slow moving, likely, depending on where you are. Quotes of the week, 2 quotes both from Barron's Sunday. Love Barron's Daily, love Barron's Weekly. It's one of my main sources, but I read a lot. Number 1, the recent rise in long-term rates may pose some additional restraint on economic growth. May? Well, I think it is. Potentially obviating the need for more rate hikes to create some slack. But that's hardly assured. The bottom line is that rates just might need to rise more than recognized given the circumstances. Well, that's true. It may go up a little bit more, and then it'll be flat for a long time, probably. The other thing is corporate earnings season may not clarify unusually cloudy conditions in the financial markets, bonds, commodities, stocks, and options. The operative fact of this earnings season is that it is immaterial if a company beats earnings by a penny or ups a stock buyback or dividend, they say, and offers a constructive outlook if something happens to interfere with the ability of capital to flow across borders. Well, that's just another issue on top of all the others, which is now we have international issues in terms of China and being so hostile, and the Middle East, a potential explosion there in terms of oil prices. And that's on top of all the other issues. There's a lot of issues out there. So as always, we say be defensive. 5 most interesting stories of the week. Well, the first one I just mentioned. So there's nonstop coverage of the Middle East. Everybody knows most of this news. But here's my one point that I don't think everybody is really on top of. And that's, I believe that this could go on a long time. I'm not saying that nobody's saying no, but it seems like every day in the news, it's like any day now when Israel's going to invade Gaza, it's imminent. But for 2 weeks now, since the initial attack, they've been saying that. But I remember on this very network saying when the Ukraine war broke out and everybody was saying, oh, this will be over in a week or two. I said, wait a minute. People said the exact same thing about World War I. Surprisingly, when World War I broke out, it was all over. Everybody thought, not maybe everybody, but a lot of people, the papers, whatever, were still saying, oh, this will be over in a week or two. Well, it didn't take a week or two. Now Ukraine didn't take a week or two. I think Israel may be dug in where they won't invade, and nobody knows again. But if I just put myself in their shoes and say, maybe I don't want to invade right away. Why? Number 1, hostages. 2, U.S. pressure on Israel maybe not to invade quickly. But 3, they're in a sort of winning position now, even though it's not a total victory, because they're bombing the heck out of Gaza, 1. They're getting people to move south, although I heard today horribly that Hamas I don't know if this is true, but I read it in a reliable source, and they said that some of the terrorists, or at least some, are shooting people in Gaza who are trying to leave, so to prevent them from leaving. So, but the point is, Gaza is short on fuel, and I hate to say it, but it's true, food and water. So, and meanwhile, Israel's flattening, things in northern Gaza and waiting for people to go south and the hostages and everything. So why are they rushing in? You could say a world opinion, but they seem to have most of world opinion on their side this time, given the atrocities that Hamas did commit. So they could wait and just play this out very slowly, make a few small attacks into there, maybe to save a few hostages over time, but just basically wait until Hamas or the Palestinians in the northern part of Gaza just say, we can't do this anymore. But we will see. It could be over. There could be an imminent attack as the show goes on. Nobody knows these things. But that's my point. I think it might go very long. In another difficult situation in the U.S., encounters on the southern border just hit a new high. It's like every week. September broke records at the border. There were 269,000 and change apprehensions recorded. Border officers have now seen 2.4 million encounters in September 30th. Now, that doesn't count getaways, which are substantial. These are just the people they caught. There's an average of 1,100 getaways every single day. interestingly, just a footnote, the majority of the people coming over from Venezuela, 54,000 arrests, and also Mexico was number 2 at 39,000. But here's the other side of the story, and this really is a concern, and this could affect the markets in big time. So this is from ex-speaker Kevin McCarthy. He said, quote, "We just caught 18 people last month on the FBI terror list coming across our border. More than 160 have done it this year. As a matter of fact, 169 was the last count on the watch list. So they've caught 169. But these terrorists are probably pretty smart compared to in terms of evading getting caught. So maybe even the gotcha ratio is higher, and it's a lot more. And here's the point: you go start digging in and say, in the last roughly 2 weeks, from 10/1 to 10/14, ready for this? These are just the arrests, by the way, not the gotchas. 2,000 Chinese migrants, almost all military-age men, in groups of 5 to 15. There were also 30 Iranians, 60 Syrians, 35 Palestinians, 100 Russians, and 285 Afghans. And again, this doesn't count getaways. These are huge numbers in 2 weeks. How many of those people are terrorists? Maybe none. I don't know. But the problem is nobody knows. Nobody can say what they are. The Chinese people, by the way, are all saying, I can't speak English. I don't speak English. They could. These groups of thousands of Chinese migrants in large groups of men could actually be partly plans from China. I don't know, but nobody knows. Nobody can say. So hopefully there's very few terrorists in this group, but we do know hundreds have been caught in 169, and many more got in who we know are terrorists. This could really affect the markets. It could affect elections. It could affect everything it could really be a shock if all of a sudden America is attacked from the inside. I hope not. It's really a dangerous situation. Story number 3, Rite Aid filed for bankruptcy this past week. There's been a lot of insolvencies among small and medium-sized companies this year, but obviously the economy is still growing. But my point here is, number one point to me is, we are in a fast-changing market in terms of investments, and the world is moving faster than ever. And you have to be very careful. I've always stayed away from drug stocks for a long time, especially Rite Aid and that thing. Why? Because of one, Amazon. I'm looking, well, if Amazon can deliver fast and faster, maybe people won't go out to the drugstore, or maybe they can get better prices. They can shop there. So I'm not a big investor on the drugstores, but so many sectors are affected by the fast-moving economy. Number 4, interesting story. Rising home prices aren't always good news. With mortgage rates at 7.63 and home prices up a lot, there's a new effect, basically. So home equity is on average about half of the average retiree's savings. And the average retirement savings, by the way, is about $223,000, which seems low to me if we keep getting inflation, particularly. But so home equity was a very important part of inflation. In retirement. And the point being that when people retire, they say, okay, I can downsize my home. But now, because of one, capital gains for some people because of higher prices, which they have to pay taxes on their home sale. But number 2, because now the high rates, it's very hard for somebody to say, I'm going to sell my larger home and move to a smaller home. So people are locked in, but I think eventually rates will come down, but it'll be a while. Number 5 story, actually the only one that's not totally negative. Sorry about that, but it's just the flow of news. Sometimes it's interesting. So Amazon, who I mentioned before, is expanding plans to deliver deliveries by drones in the UK, Italy, and the US by 2024. They have drones now that can deliver items up to 5 pounds, and they're talking about 1-hour delivery potentially for drugs, medications. And they have a new class of drones called the MK-30s that are quieter and can fly in a range of weather conditions. So it'll be a changing world, but again, it just shows you how even Rite Aid was in trouble before because of the Amazon effect. But if you can get deliveries of a lot of items at home by drones, it's going to affect some businesses. So we'll take a quick advertisement, and we'll be right back with our investment of the week and our panel discussion of the week. See you soon.
One of the things that business owners forget a lot is to prepare for their own retirement.
Hi, my name's Nick Palavita, and today I'm with a very special guest, a certified financial planner, a chartered retirement plan specialist, and president of National Pension Partners, Max Quillette. Max, tell me what you do at National Pension Partners.
Well, Nick, we help successful small businesses and professionals put together retirement plans that provide them the maximum retirement benefits and big tax deductions at the same time.
Well, how do you do this?
Well, we get on an internet conferencing system with the client. We review their goals, what they want to accomplish, and then put together strategies to help them in implementing a retirement plan that benefits them, not everybody else.
Well, that sounds really good, but how much does this cost?
Well, it's really not bad because the first consultation is free. That allows us to go through and discover whether this strategy works for that business and for you as the business owner, and helping you maximize your retirement.
Well, Max, how do we get this free appointment?
It's really pretty simple, Nick. You can either go to our website below or call us at 877-252-1692, and then we can set up a time with either myself, Nick, or one of our other retirement plan specialists, another CPA or advisor in the office, to go over this with you and make sure it fits for you.
Hi, my name is Lewis Haupt. I work with National Pension Partners, and I work with businesses to allow them to put the maximum away that they can for themselves and to save taxes.
Hi, I'm Brad Coyle, and I'm the brokerage manager at National Pension Partners. We're always analyzing plan fund choices in order to ensure the participant's success.
If you want more information on how we can help you and your business put more money away in a retirement plan than you ever thought possible, contact us at the website below or call us at 877-252.
And we're back. So what to do, as we've been saying for a year and 3/4 now, own energy and especially pipelines. I mean, MPLX is a perfect example. I believe pipelines will probably, because we can never guarantee anything, but likely give about a 17% yearly return, as they have historically in most periods, except for when energy dropped so much from 2015 to 2019 or so. But we're in a period where energy is probably going up, and certainly, I think, going to stay flat, in which case the pipelines are really utility type safety with high dividends and potentially growing dividends, no guarantees. Number two, own dividend stocks, as we've shown many times, our favorite chart. If you had owned dividend stocks compared to the S&P 500, you got double the return or triple the return if you had dividend growers. So you want to own dividend stocks. They have a pad in bad times because you get the dividend, and they outperform in good times based on 50 years of performance. And number three, be defensive, because I think it's still a rough time, especially this fall now. Earnings are coming out and the market doesn't look good. Even the tech effect is, a lot of the tech companies have been really hurt recently by their reports because their outlooks, particularly, even if they're showing good cash. So panel, we're going to the dividend discussion of the week is going to be combined. So Nick will come on. Normally we do a separate panel discussion and dividend investment of the week, Nick. But this week we're combining it for one reason is I can't be sure. So I want Nick's opinion too about this question. But first, disclaimers as always. This show is entertainment only. Nobody can guarantee any investment at all. And that's true this week too. I can only take my best guess. I know what I'm doing, but that doesn't mean it'll be proven right, because nobody can guarantee anything. It's just our opinion. So the question this week is, with rates at 5% roughly on cash, 5% on long-term treasuries, and 5% on short-term treasuries, what part of your portfolio might be in stocks, in non-stocks? And also, the other side of that is, do you go short-term cash, long-term? ride it out in short term until the market turns around, buy long term and lock it in. Quite a lot of background, and then we'll open it up. So number one, just a year ago, a year and a half ago, rates were pitifully low. I was helping a friend, and he was looking at CDs and munis, and it was like 2% yields, and you never knew that it was going to ever come back. But it was a real strain to get any good fixed returns. Now there's maybe a one-time opportunity, maybe it's a bad opportunity, maybe it's a bad time. Number two, and of course rates are up because of inflation, the fight against inflation. We do think the fight against inflation will be a long one, but nobody can guarantee where rates will go, just like nobody can guarantee stocks. That in this context, one of the main things you have to mention is the U.S. and the world, and we'll discuss the world in a second, but the U.S. has huge, huge deficits. It's unbelievable. 33 trillion on the books is unfathomable alone. You just can't count. No, you can't count that. You can't even imagine 33 trillion. I think they said something about like if you stack dollars, you can get to the moon or something with that much debt already. But the point is, what they're not telling you is that the real debt could easily be 150 to 200 trillion with off the books liabilities, because the U.S. government has promised basically a part of Medicare for free, Part B, and you pay for it, but Part A, the hospital is free. And other countries have promised free healthcare for aging demographics, but nobody put anything aside. The U.S. took that money that was supposed to be put aside for that and spent it. And same thing for Social Security. That money was supposed to be locked away, and the same thing with other governments who have underfunded their pensions. So it's not just a U.S. problem, it's a worldwide problem. So with massive deficits, there could be two results. One is, the one I can tell you for sure is inflation is probably going to be higher than any rates of return on either the bond market or the stock market, unfortunately, because they're going to try to inflate away. They're going to have to inflate away some of these massive deficits. But long-term rates could go much higher, or on the other side, the U.S. government and other governments are going to try, and very likely successfully in my opinion, but it's hard to say, use yield curve control. Yield curve control, you can look up, because I don't have time on this show, but I've explained it before, but Japan has been using it for over a decade. The U.S. used it in World War II. It's no secret. Basically, the government tamps down rates by buying back bonds over a certain amount, and it has worked several times. So that could drive rates. If the U.S. government has its way, and other governments, they might say, we can't afford to pay interest on this debt. We're bringing it down to zero. And also demographics is deflationary. So the question is, though, what do you do in this investment environment, given the fact that, the last point is, if they lose control, inflation and rates could go through the moon. We could have like a 1970s scenario, which did happen, where people could get 14% in a CD and a treasury. And you don't lose by buying a 5%, but you get slaughtered on the principal and you have to hold it to maturity, and you've lost a lot of opportunity cost. Nick, what do you think?
Well, I think in the short term, they're going to go up, but very slow. They're going to increase at a decreasing rate. We've seen interest rates jump very quickly over this last year, but now if it increases, it's going to be really slow. Target maybe 6%. CDs are paying more than 5%, sometimes 6%, depending where you shop. And it's unheard of 10 years ago when interest rates were so low, or even 5 years ago, 3 years ago. Such a big change. It was such a big change. Remember in 1984, when I first started doing estate planning, client would come in with $1 million in cash and say, how you doing? Doing pretty good. I said, where's your money invested? CDs, I'm making 10%. I'm making $100,000 a year.
It was easy back then, right?
Easy back then. Then 2 years ago, somebody came in with $1 million. How you doing? Not doing too good. Why not? I have it in CDs. I'm making 1%. I'm making $10,000 a year. I'm in poverty. So we've seen a big dramatic change due to this interest rate adjustment on the upswing. So I think we're going to see that if it increases, it'll increase at a decreasing rate right now, because inflation has been coming down. However, we've got another problem. Your friends in Washington, D.C. want to spend another $1.5 trillion that they don't have, borrowing it with the American credit card and putting it on now a very high interest rate. So what are they going to do in Washington? Like it or not, it wasn't the Fed who created the inflation. It was Washington, D.C. It looks like we're looking for another round of inflation because they can't find a dollar they can't spend. And since
I mean that I can't disagree with, except for I don't think, again, I'm just guessing that rates are going to go much higher, especially the long-term rates. And I'll tell you what, I think the Fed might raise another quarter, but they've been saying higher for longer, and I think they're going to be conservative because I think it will eventually affect things. But I wouldn't be surprised to see a quarter or a half more. The other side is I wouldn't be surprised if that was it. And the thing is, as soon as the market realizes that it's inevitable, in my opinion, that we're going into a recession eventually, maybe in 2024, likely, then long-term rates are going to go down because people are going to say, you know what, I'm willing to take 4%. I wish I could get 4% like last year, So I can't remember his name. Somebody who, he's an investor. I read the book, and he said basically, if you see an opportunity in real estate, grab it. And you know what? Personally, I took my Roth IRA and I put it all into 5% treasuries. Basically, I went as long as I could. I also went with a high coupon, by the way, because I figured in case whatever happens, I'd rather have a 3 or 4% coupon or, higher. I think, grab some 4% coupons because this way, my strategy is, since it's all tax-free anyway, let's say I get 4 and rates go up. I'll just reinvest it. I'll be okay, great. I'll take 5 if I can get 5. If I get 6, get 6. But the other side is if they go down, then that will have been a one-time opportunity. And my theory is most likely the governments very likely will control. They need to control yield, and they can keep printing money. Basically, they're buying back their own bonds of a certain rate. They can print lots of money, but that will cause inflation. But the other side is paying interest on that will cause more inflation. So they don't have a choice. They've done it successfully before Japan did it, and it worked really well. They've had very low inflation for, I think, 16 years now. So my theory is you grab it when you can, but I wouldn't be surprised I regret it. But here's the main point is if I'm wrong and rates go up, I haven't lost anything if I'm holding these things for maturity. I just bought 30-year bonds, 28-year bonds, whatever. So I'll just reinvest the money. I haven't lost anything unless I sell. It might go down on paper, but if I get an income, it's like, you know what? I have to work for salary, but if I'm getting an income from my Roth and it's tax-free, I could have made more. But the point is, that's why being a working man, by the way, gives me appreciation for dividends. It's like, because you realize, hey, they're earning money instead of me, and it's hard work. But the other side is, if rates go down, this could be, and that's my theory. It may be this year the top, where you could maybe get it. Maybe it'll take longer, but it could be this week, this month. Rates were down today. Who knows? But the point is, if we, in another year or 2 or 3, we're very likely, in my opinion, to look back at this and say, you know what, those were great rates. I wish I had grabbed them. And then you might even get a great capital appreciation because if you go long-term bonds, they'll go up. And then you could maybe sell them and go to the stock market. But if they don't go up, you know what? I'm just grabbing the income for life. It's like a pension, and why not? And the other point, which I always bring is if anybody takes a look at the 20 or 30-year treasury, over 40-year history, it was like, it's been a straight line since the 70s, since 1980, maybe around there. Since 1980, it's been almost a straight line down, not even with curves. It's been a straight line down, because they're stimulating the economy. Then around COVID, all of a sudden it dropped because they tried to stimulate. Now it's above because they're trying to make up for all that spending. But eventually, I think we'll return to that straight line, in which case we're looking at close to zero rates in maybe 6 years, maybe 7 years. I wouldn't be surprised. And if we're in that environment, it'll be like last year, where it's like, well, I can buy stocks or I can get nothing on my bonds. And, stocks have their own risks. And there's going to be a lot of risks in the stock market in the future with a lot of changes. And some companies will do well, but there's a lot of other risks. There's always more risk in the stock market and potentially more reward. So for that part of my bond portfolio, I'm willing to go long. I'm happy with it. And if I'm wrong, I don't care because I'll just take the income and reinvest it, and then I'll win that way. But, it depends again on your time frames, depends on a lot of things. But, who knows? Again, there's never a guarantee. But we're out of time. We'll be back next week. Thanks for watching Wall Street Hackers. As Kim always says, get healthy, get wealthy, and we'll see you next week. Thanks, Nick.
Next week. Bye-bye.